You're about to miss one of the biggest tax breaks in American history. And here's the wild part. Most people don't even know it exists. While the media is busy arguing about politics, buried deep inside the new Trump tax plan is a hidden opportunity, a massive one, that could save you thousands of dollars in taxes if, and only if, you know where to look. This isn't some gimmick. It's not just for billionaires or corporations. It's real. It's legal. And it's already being used by investors, business owners, and smart everyday Americans. So here's the deal. If you're a W-2 employee working that 9 to 5, if you're a side hustler, a small business owner, or someone trying to build wealth in this chaotic economy, this tax plan could actually work in your favor. But most people, they'll never hear about it because they don't understand the system. Or worse, they think the system isn't for them. Truth is, the tax code isn't designed for the average person. It's designed for the informed, for the financially aware, for those who ask better questions and make smarter moves. So in this video, I'm going to break it all down. What changed, who benefits, and how you, yes you, can use these exact strategies to lower your taxes, keep more of your money, and finally take advantage of the system, instead of letting the system take advantage of you. No fluff, no politics. Just real talk, real examples, and real ways to win. You ready? Let's dive in. All right, so let's break it down. Under the old tax system, your income was taxed in layers. Like if you made $50,000, part of that was taxed at 10%, part at 15%, and the rest somewhere up at 25%, depending on which bracket you landed in. And if you made over $500,000, you were looking at almost 40% of that top income going straight to taxes. Gone. But now, things have shifted. With this new tax plan, those brackets are lower. For a lot of people, especially if you're somewhere between $50K and $600K, you're keeping more of your money. That 25% tax rate? Now it's 22%. That 28% tier? Down to 24%. And even the top bracket dropped from 39.6% down to 37%. That's real money back in your hands. And I get it. Some of you are thinking, cool, but I don't make six figures. So what's in it for me? Fair. But here's the thing. The standard deduction, the amount of money you don't get taxed on, just went up too. In 2024, if you filed as single, your deduction was $14,600. Now, it jumps to $15,750. Married and filing jointly, that goes from $29,200 up to $31,500. No paperwork, no itemizing, it's automatic. But it gets even better if you're over retirement age. Because now, seniors who make less than $75K a year, you get an extra $6,000 deduction. That means a retired couple could see $12,000 off the top, tax-free. That could wipe out your tax bill completely, especially if you're living on Social Security or fixed income. Huge. But let's talk about something totally new. Because this part, no one's really talking about it, between now and the end of 2028. If you earn overtime or tips, yes, tip income, you might qualify for a tax write-off on that money. If you're making under $150K as a single filer or under $300K as a married couple, you can write off up to $25,000 in tip income and $12,500 in overtime pay. Let that sink in for a second. You're out there working late, pulling doubles, picking up tips on the side, and now, for the first time, that income could be partially tax-free. That's a massive shift for people in hospitality, healthcare, delivery, retail, anyone grinding for those extra hours. Now, there's one more thing here I want you to know about. It's something they're calling the Trump account, and this part is specifically for newborns. If your child is born between January 1st, 2025 and December 31st, 2028, they'll automatically receive a one-time deposit of $1,000 into a government-backed investment account, not a check, not a cash payment. This is money that gets put away and grows over time, tracking the stock market. Your child will be able to access part of it when they turn 18, and more as they grow older. It's not a fortune, but it's a foundation, a first seed planted for long-term growth. And yes, parents can contribute more to this account too if they want to. Now, none of this is political. I'm not here to tell you which side to vote for or what to believe. What I'm saying is, these are real changes, real dollars, and real opportunities that most people will miss simply because they don't know how to use the system. And this is just the beginning. Because the next part, the part they never teach you in school, is where wealthy families and small business owners are already stacking advantage after advantage using something called bonus depreciation. That's coming up in part 2, and trust me, even if you've never owned a business, you're going to want to hear this. All right, let's go deeper. So, you've heard of tax write-offs, right? Stuff you buy for your business that you can deduct to lower your taxable income. But this next part, this is where the smart money lives. It's called bonus depreciation. And in this new tax plan, it's been brought back to 100%, which, if you understand how to use it, can be a game changer. Let's start with the basics. Imagine you own a small business. Maybe you're running a factory or a warehouse or a print shop, and you've got to buy a piece of machinery, something big, maybe $30,000 worth of equipment. Now, before this tax update, you'd only be able to write off a portion of that, like 40% in year 1. Then you'd write off the rest slowly, over time, year after year. But now, that rule's changed. With this new plan, you get to write off the entire cost 100% in the same year you buy it. That means if you spend $30,000 on qualified business equipment, you're getting a $30,000 tax deduction right now, not later, not over the next 5 years. Today. Now you might be thinking, okay, cool, but I don't own a factory. Fair, but let's level it up. Let's say you're an online content creator. You film videos, maybe you do product reviews, or you're building an audience on TikTok or YouTube. And to build your brand, you decide to get a G-Wagon. Yeah, a Mercedes SUV. Sounds crazy, right? But hear me out. If that vehicle weighs more than 6,000 pounds, which it does, and you use it at least 50% of the time for business, it can qualify for bonus depreciation too. And if you're using it for your brand, for shoots, for client meetings, for business travel, then yes, it qualifies. Let's say the G-Wagon costs $100,000. Under the old rules, you'd maybe get a $40,000 write-off the first year. But now, with 100% bonus depreciation, you can write off all $100K in year 1. Now, let's say you didn't pay all that in cash. You only put $10,000 down. That means you get a $100,000 write-off for something you only put $10K into. The rest is on financing. And suddenly your taxable income, it drops by $100,000. You earned $100K in your content business this year? Well, after that deduction, the IRS sees you as making zero, which means zero income tax. And yeah, it sounds wild, but that's exactly what a lot of people are doing. Entrepreneurs, content creators, freelancers. They're using the rules, legally, to invest in their business while slashing their tax bills. But it doesn't stop there. Let's dial it in for people just getting started. Say you've got a day job, maybe in tech, making $80,000 a year. But you're also trying to launch something on the side, maybe a podcast or a small media brand. You form an LLC. You buy gear, camera, mic, lighting, maybe even some software subscriptions, maybe a laptop. Altogether, you spend $25,000 on your new venture. Under the old system, you'd write off just part of that in year 1. But now, full write-off. You can deduct all $25K immediately, even if your new business didn't earn much. Let's say you only made $5,000 from your podcast that year. You spent $25,000. That's a $20,000 business loss. But here's where it gets smart. You can use that $20,000 loss to offset your W-2 income, your day job salary. So instead of being taxed on 80K from your job, you're only being taxed on 60K. That's how you pay less in taxes while building something real on the side. And it's 100% legal, as long as you're documenting everything and actually using those expenses for your business. But let me be clear here. This only works if you're doing it right. You've got to keep receipts. You've got to prove that these were real business expenses. You can't just buy a car and claim it's a tax write-off because you took one business call in it. You need logs. You need consistency. You need records. Because yeah, the IRS can ask questions, and if they do, you want to be ready. A good accountant will tell you this. A great attorney will remind you. Documentation is everything. That's why high-income earners work with professionals, and not because they're hiding anything, but because they're planning ahead. And if you're wondering, is this only for people making a ton of money? The answer is no. This is for the side hustler, the new creator, the first-time entrepreneur. If you understand the rules, you can use the rules. And with this new 100% bonus depreciation brought back into play, it means there's never been a better time to start something and write it off the right way. All right, let's finish this out. So, we've talked about lower income tax brackets, about overtime and tip deductions, and about how bonus depreciation can give you some serious leverage as a business owner or side hustler. But there's one more piece that's absolutely critical, and most people don't even realize it exists. It's called the 20% pass-through deduction, also known as the QBI deduction. And if you're a small business owner, freelancer, or even just running a side hustle through an LLC, this could be a major tax break for you. Here's the short version. If you run a business where the income passes through to your personal tax return, like an LLC, sole proprietorship, S-corp, or partnership, this rule lets you deduct 20% of your business profits automatically. Let's break that down. Say your business pulls in $200,000 in revenue. You've got $100K in expenses, equipment, payroll, rent, tools. That leaves you with $100,000 in taxable business income. Now, under normal rules, you'd pay income tax on all $100K. But the QBI deduction kicks in and says, hold on, we're going to knock 20% off that just for being a qualifying business. So now, instead of being taxed on $100,000, you're taxed on $80,000. That's a $20,000 deduction, with no extra work, no extra paperwork, no special write-up. Just boom, 20% off your taxable business income. And it's not a one-time thing, and it's every year. Originally, this was supposed to expire in 2025. But under this new tax plan, it's made permanent, locked in. But like all good things in the tax world, there's a catch. There are income limits. If you make over $200K as a single filer or over $400K if married, you might start to lose some or all of this deduction, especially if you're in a specified service trade like law, medicine, accounting, consulting, etc. But if you're below those thresholds, you're golden. And even if you're above them, a good tax advisor can help you structure your business in a way that still lets you qualify. Again, it's not about loopholes. It's about playing by the rules, with strategy. Now let's talk investors for a minute, because the tax code doesn't treat investment income the same way it treats regular income, and that's by design. Capital gains, money you earn from buying and selling stocks, real estate, crypto, whatever, those are taxed at lower rates than your salary, and if you hold your investment for more than a year, that's long-term capital gains, and it comes with lower taxes. But here's where it gets smart. Imagine this. You invest in a rental property. The rent comes in, you pay the bills, and what's left is profit. But because the property depreciates over time, the IRS lets you deduct a portion of its value, even if the property is actually appreciating in real life. That means, in some cases, you could be making money every month but showing a tax loss on paper. You get the cash, but the tax bill might be zero. Now that's what the wealthy understand, and the middle class is just starting to learn. Taxes aren't just about what you earn, they're about what you keep. So here's the real question. Are you going to let these changes pass you by? Or are you going to lean in and learn how to use this system to build wealth instead of losing it? Because listen, this isn't about being rich or playing games or doing anything shady. This is about understanding the system we all live in and making it work for your family. If you're working a job, building a side hustle, investing in real estate, creating content, running an online store, whatever it is, you've got options now that didn't exist a year ago. And the sooner you start paying attention to these tax tools, the sooner your money starts working smarter. But one word of caution: don't try to do this alone. This stuff can get complicated fast. That's why you want to work with a licensed tax professional, an experienced accountant, or a firm that understands the game and your goals. Someone who's there to guide you, not just file your return. So here's what I want you to do. Start paying attention. Talk to an advisor. Learn the rules. Ask questions. Be proactive. The people who win at this game aren't the ones with the highest income. They're the ones with the most awareness. And if you want more deep dives like this, explained in real language with real examples, make sure you subscribe. Turn on notifications. Drop a comment and let me know what you want to learn about next. Because this economy is shifting fast, and if you don't adapt, you get left behind. Thanks for watching, and remember, every dollar you keep is a dollar you can invest, grow, and pass on. Stay sharp. Stay smart. I'll see you in the next one.